Hey, how's it going, everybody? Welcome to Finance with Ava, and today I'm going to be talking about ETFs. What are they? How do they work? And definitions of some of the major terms that are associated with ETFs. And I'm going to be describing these things in a basic and also somewhat advanced description here. So hopefully anybody that's interested in ETFs will learn a lot from this video, or maybe just as a refresher to remind yourself, what are ETFs and the differences between them and similarities with some other major funds and everything. So let's get into what are ETFs. ETF stands for Exchange Traded Funds. Exchange Traded Funds are investment funds that contain several securities in one group. Often this selection is referred to as a basket or pool. So oftentimes you'll see an exchange traded fund and you'll see the securities that are a part of them be referred to as a basket or pool of securities. And these securities that ETFs contain can be stocks, bonds, or commodities. Usually it's associated with one of those, mainly stocks or mainly bonds or mainly commodities, but you do have mixed ETFs that contain some of each ones and everything right there. And ETFs typically track a specific index, sector, or commodity, theme, or certain asset. And tracking these specific categories determines what kind of securities the fund contains. There are a lot of different types of ETFs. There are some that track, major indexes like the S&P or the NASDAQ, or certain sectors like finance, utilities, healthcare, certain commodities, gold, oil, certain themes, metaverse, gaming, different themes like that, and certain assets. So a lot of different types of ETFs. And ETFs provide liquidity, diversification, flexibility, transparency, accessibility, and are available at low cost to investors. These are some of the main reasons why investors choose ETFs, because their liquidity, you can get in and out of them quickly. They're on an exchange, and I'll talk more about that later. And that diversification, investing in an ETF can provide a lot of exposure to a lot of different various stocks without having to actually invest in that specific stock. You'll be investing in an ETF which will hold those various different stocks, so you can go along with them without that risk right there. There's less risk often in ETFs, and that flexibility of being able to get in and out of the ETF, transparency on the websites for the ETFs, a lot of them, like the Vanguards and the S&P and State Street and all those, you can look into them iShares, and see a lot of breakdown of the ETF, what are the holdings, the different fees and everything associated with it, and the different yields and different things like that. And accessibility, exchange traded funds are available to us retail investors. Me and you is what they call us, retail investors. We're not associated with some major bank to be able to have to invest in this or have a certain amount of capital to invest in something like this. No, ETFs, just like on a stock exchange, can be just traded, can be bought, and with the mobile apps now and investing, it's very easy. And I'll show you later on how easy it is to be investing in an ETF, either one time or reoccurring, just very accessible and available at low cost. There's the expense ratio, and we'll talk more about that later, but the fee associated with ETFs is very low compared to some of the other funds that you can invest in, especially with all that exposure for diversification and possible growth and less risk with the costs associated with them. There is a lower risk, more reward situation that can happen with investing in exchange traded funds sometimes, if you're picking out quality, great exchange traded funds. And we'll talk more about that later as well. And I'm actually working on a video of my top 5 favorite exchange traded funds, where I'll break down my favorites and even the ones I'm invested in. For me personally, I'm mainly invested in individual stocks, but I'm also invested in a couple of ETFs to get that exposure to all those different sectors that I may not be that heavy in my individual stocks. So it makes a nice balance to add a lot to your portfolios. And for people who aren't maybe into stocks a lot, into the stock market, ETFs are definitely the way to go for you. Even your whole portfolio, various different ETFs will provide you a lot of possible growth with your portfolio, where you don't even really need to be in individual stocks at all. Just get several ETFs and cover your bases, with dividends and maybe some international exposure, the US major large cap, mid cap, just various different ETFs, and you'll have a solid portfolio with a lot of growth, and just reinvest in that reoccurringly, every week or every month. And that's definitely a way to go. You can build a whole great portfolio with just exchange traded funds, or mix it up, exchange traded funds and individual stocks. And ETFs can add a lot to a portfolio with you having less stress, because you don't have to worry about it. You're not the one picking the stocks, selling them, buying them, and different things like that. You just pick quality exchange traded funds and let them handle all the work with handling the in and outs of the stocks and everything. And you can have less stress, less risk, and just reap the rewards of that growth, of the dividends and everything like that. So that is definitely a great way to go, especially for people who aren't really into individual stocks. Having a solid portfolio of several different great ETFs is a great way to go and provide some nice growth over the years, especially long-term investing. It's great to invest in exchange traded funds. And that's what I suggest to people who aren't really into individual stocks. And that's totally fine. ETFs, exchange traded funds, you could build a solid portfolio with them to get some nice growth. But let's get on to the rest of the video here. So a lot of times when I hear people talk about ETFs and exchange traded funds, one of the main questions is, aren't they the same as mutual funds? Or what's the difference between the exchange traded fund, an ETF, and a mutual fund? Or are they the same? Nope, they are not the same, but there are similarities. Like mutual funds, an ETF is a type of fund that holds several underlying assets. So those securities they hold, they're underlying assets. Holding several assets, like many different stocks, bonds, and or commodities, helps provide investors of ETFs diversification. That's what I was telling you about previously here. Having those different variety of stocks and everything provides a nice level of diversification, and mutual funds do the same thing as that as well. And with this diversification, like mutual funds, ETFs provide investors investment and income growth with less risk, not specifically dependent on any one investment to do well. That's what I was telling you about. You're not really like worried about like if a stock drops tremendously, it's not going to, like if you have a portfolio of 5 major stocks, maybe you're not diversified in those 5 major stocks, 3 of them are like energy and 1 bank, financial and 1 technology. Let's just say like energy does terribly right there. So you got 3 stocks that took a major hit, and it's just, macroeconomic conditions can affect the whole bunch of stocks. Even if a stock is doing well, great cash flow and everything like that, macroeconomic events in that sector in the world can just crash the market. I mean, it could just do that in general. We've seen that lately with the virus and with the inflation, everything like that. It's just stocks taking a hit, even if they're doing well. And then, if you break it down per sector, a certain sector taking a hit, like you just say in that scenario, we have 3 energy stocks or something, and the energy sector takes a big hit. Well, then boom, you're just devastated right there in your portfolio. However, if you have different ETFs, maybe you got an energy ETF, you got utilities, you got healthcare, you got different ones like that, and you have a lot of different stocks in those and securities in those. Then a sector or 2 take a hit, well, you still got all those other sectors and everything doing well. And even more specific than that, a certain company takes a hit. Maybe you're the one who holds that individual stock, that company, and it takes a hit in your portfolio, and you only have a couple of different stocks. Well, then your portfolio is really going to take a hit. And we'll just say specifically, in an example, we'll just say in healthcare, a certain healthcare stock you has, they come out with a certain drug, it does really bad or something, something happens like that, and then that stock takes a major hit. However, if you have like an ETF in healthcare or something like that with several different healthcare stocks, well, that ETF may only hold like 1% of that ETF may be of that one stock that did really poorly, and it takes a slight hit, but it has all those other companies, all those other stocks in that ETF to help prop it up, to help it grow, everything like that for that moment. If that, stock maybe recovers and it comes back and helps out. And if it doesn't recover, you got all those other investments in that ETF that pretty much overshadow that, so it doesn't make it as big of a hit. So you're not specifically dependent on one investment to do well. With the exchange traded fund, it has several investments inside of it, which is similar to mutual funds. And with ETFs, they offer a wide variety of investments. Like I was saying, United States, international, different market caps, large market capitalizations, medium, small market capitalizations, sector specific, dividend focus, growth, value. There's so many different types of exchange traded funds. You can focus in on certain ones. Maybe you want to get more exposure to a certain country, growing emerging markets, maybe just technology, you want more of that. Maybe you want a dividend focus, you want growth focus. There are ETFs for all these different themes and certain focuses that you want to, zone in on. Or if you want more broad selection, you want just, United States large cap or just a world large caps, there's ETFs for that. You want a broad focus, you want a narrow focus. You could definitely have a nice mix and variety of exchange traded funds because there's so many great ones available, and there's several really key ones available as well. Like I said, I'm working on a top 5 video, and I'll have a link down in the description when I'm finished with that, of my top 5 favorite exchange traded funds and some also alternatives to those top 5s as well. And like mutual funds, exchange traded funds are both managed by professional experts, and those professionals choose and monitor the assets to invest in. So that's that less stress part I was talking about, of course, where you're not the one having to choose the stock, worry about the finances of the stock, get out of it. Okay, I need to switch this one to this one, it's not doing too well, the growth stop, I gotta, okay, let's exchange that with another one, let's swap. Okay, what do I need to buy? Okay, well, what's going on? You're not the one dealing with that. These are professional experts. They get paid to deal with that right there. And they want to do well. They want you to be investing in their ETF, in their mutual funds, so they're going to want to do well. You can look at the data, the statistics of an exchange traded fund like a mutual fund to see how the 1 year is, how the 3 years, how, the fund is done in 1 year, 3 years, or 5 years, or over the life of the fund. So, and you look at that, you want it to be well. They want it to be well because they want you to invest it, of course, because there's an expense ratio. They get a part of the fee. They get a fee of, from you and everything to handle all this for you. So they want to do well, so you will invest in them. So it's a win-win for both, parties associated with it, you as the investor and the professionals who are managing these funds and everything. Because like I say, you can see how well the fund is doing. Of course, they want to do well because they want to do well. I mean, I wouldn't want to do well in a company investing, of course, just for the job itself, but also so you have the people investing more in your fund. Because if your fund is not doing well, you have less people investing each year. Well, you're not going to have the capital to have the assets and everything. And funds can shut down. They can definitely shut down. If they don't have the assets, the funds to support the fund, then that's it. I mean, so a lot of quality funds, you'll see how long they've been around, and you can really tell that as well. ETFs aren't as old as mutual funds, so there's not many that have been around a long time, but we'll talk more about the specific one, the oldest one, and when it was started and everything like that. But so you can definitely see a lot of information on exchange traded funds to see how well they're doing. And time, that's another thing. You can't really put a value on time. Time is super important, super valuable, and that's less time for you having to deal with all those decisions and actions and everything. When you have a professional handling all that for you, you're just putting in the money and sitting back and recouping the benefits, the dividends and the growth, the capital gains, and letting them deal with all the time and stress of making those decisions and investing and researching. And let's get on to some of the differences here. So yeah, that was a lot of similarities between ETFs and mutual funds. So I get it. The question still remains, are ETFs the same as mutual funds? Nope, there are differences, and here are some of the main ones right here. Unlike mutual funds, ETFs are available to be bought and sold throughout the day on a brokerage like stocks. So when the market is open, you can go in there, buy an ETF and sell it, throughout the day right there. Not like mutual funds. You can't do that with mutual funds. So that pretty much breaks down the ETFs, exchange traded funds. I mean, the name itself pretty much describes what it is in a sense right there. So yeah, you could buy them and sell them throughout the day. Even, the same day, you could buy an ETF and all of a sudden decide, oh, maybe I don't want that, and sell it that same day. So it can be bought and sold throughout the day on a brokerage like stocks, just like that. And another difference, the prices of ETFs fluctuate throughout the day. Just like stocks, the amount can go down drastically, up drastically. The volatility can go up and down, usually not as much as stocks because, you got that whole basket pool of different securities and everything like that. So they don't jump usually as much percentage-wise as stocks, but they do fluctuate throughout the day. Whereas a mutual fund's price is calculated and determined after the market is closed. So there's a difference right there. When you see the mutual fund price, that's what it closed at for that day. There's no really like high or low or different various amounts of prices, everything, and fluctuations like there is with ETFs. And another major difference, you can buy one share or fraction of an ETF initially and continually. With mutual funds, they typically require a minimal initial investment that's not based on the fund's share price. Once that minimal investment is met, you can then invest your choice of various dollar amounts towards that fund. So that minimal initial investment for mutual funds, it ranges. It could be a couple $100s. It could be thousands of dollars, $1,000, $3,000. I've seen various different amounts right there, but it's no easy, entry, just basic low entry like, oh, $20 or something like that. It's usually hundreds or thousands of dollars just to get invested in that mutual fund to start an investment. But with ETFs, you can buy like one share of the ETF, which ranges in price, like stocks. There are ETFs with a share price of $30 something, $50 something, $100 and something, $300. There's different ETFs, so it just varies with the prices of the ETFs and everything and the market value of them. So you could buy just one share initially and continue, or you can buy a fraction of it. With the fraction, however, not all brokerages offer fractional investing. So buying fraction amounts of ETFs is only available with certain brokerages. However, with the brokerage I mainly use for my ETF buying, I can buy fraction amounts. You can do $10, $20, $50 a week, a month. It's just a fraction amount, and you're buying that amount of the share price. Let's say the share price of the ETF is $50 a share. Well, you could break it into $25. You could buy $25 a week or something like that. And that price is going to fluctuate. So maybe it's 52, 53. We'll just say for the sake of simplicity for this example that the ETF stays at $50 a share. Okay, so you're doing a reoccurring amount of $25 into this ETF weekly. Well, after 2 weeks, you have a share of that ETF. So for fractional investing, that's how it works. You're buying a fraction of that share. So eventually you'll have a share of that ETF or multiple shares of that ETF, depending on how much your recurring amount is and the frequency of it. It just adds up over time with how much you're buying right there. Or like I said, you could buy shares at a time, limit orders. You could put in a specific amount that you want to buy that ETF at. And if it hits that certain price throughout the day with a limit order, then you're going to be buying it with that certain amount right there for that limit order, or just a market order where you just put in like, I want to buy a share of this ETF, and whatever is trading at that moment, it'll be filled like that for that amount that you put in right there. So, and it'll just take away from the amount you have in your brokerage. Just say you have $100 in the prices of that ETF is, $62, $63, where wherever you put that order in, what it's at for the market value, that's what you're going to buy it at. And it'll take away from that available $100 you have in your brokerage account. So there's different ways to buy an ETF, just like you could buy a stock on a brokerage and everything like that. And with another difference here, ETFs tend to be passively managed, whereas mutual funds tend to be actively managed. And so this comes into effect with the fees for ETFs versus mutual funds. ETF fees are typically lower than mutual fund fees, and ETFs are considered to be more tax efficient. And this goes to the management style of ETFs and mutual funds. Being passively managed, ETFs, they typically, a lot of them follow an index. So there's not a lot of buying and selling. They're just trying to mimic an index, the S&P, for example, 500. They're just trying to have a weighted certain volume amount of stocks with the S&P to kind of match it pretty much one to one. Whereas mutual funds, they're actively managed. So there's more buying and selling throughout the day, throughout the week, throughout the months with them right there. A lot of in and out, a lot of buying and selling. And so with that buying in and out of securities right there with mutual funds, the active management, more of that buying and selling, that can cause short-term capital gains, which, affect you more than long-term capital gains. Because when you buy a security and sell it within a year, that's short-term capital gains. But if you go longer than a year, that's long-term capital gains, which is less taxes and everything. So that can add up right there. That's why it's often said that ETFs are considered more tax efficient because they're passively managed. There's not as much activity, less occurring of that short-term capital gains tax and everything. And so that's why the fees for ETFs are typically lower, because the management style, it doesn't require as much hands-on, as much time, as much action in an ETF that's passively managed compared to a mutual fund where it's actively. There's more, hands-on going on right there. There's more trading, more research going on, more things like that, because you're trying to buy and sell so much more with the actively managed fund, whereas the ETF passively managed, you're just mimicking an index or a certain sector. So you pretty much know when you're creating that ETF, when the provider's creating that ETF, they're saying, okay, I want to mimic this index, or I want to be well broad in this sector. So it's a lot of like setting right there. It's not too much of that buying and selling. It's just kind of maybe shuffling around maybe certain percentages. Maybe there's a lot of growth in one, so you want to lessen your amount in that and kind of even it out, something like that. But it's more passively, whereas actively it's more buying and selling throughout the week, throughout the month, like that. So that's where the fees and the taxes can be better on ETFs versus a mutual fund. How do ETFs work from inception to investment? So this is kind of a broad overview of how ETFs are created and how do they work and everything right here. There's definitely more details and specifics to this, but I'm just kind of breaking it down in a broad sense right here in the overview. So an ETF provider determines and designs a fund to invest in certain securities. So the company, whether it be Vanguard or iShares, they say, okay, I want to create an ETF, and I want it to be, designed with this theme. I want it to follow the healthcare sector, okay? And I want it to be, maybe large cap healthcare companies, large capitalization. So they set up overall what they want their ETF to be composed of, what they want it to represent. So in that specific instance, they want it to be healthcare, maybe major pharmaceutical companies, major healthcare insurance companies, so large capitalization, that's what they want to focus on. So in this example, the ETF provider creates a basket of securities by buying and owning those underlying assets. So in that example, okay, the ETF provider are going to buy, Pfizer, they're going to buy Merck, Bristol Myers, maybe Cigna, CVS, and they're just going to create a basket of certain healthcare companies, major healthcare companies with large capitalizations. So they're buying and owning all these assets, these different stocks, to make up this new healthcare exchange traded fund they're creating. So then investors can buy a share of that basket. And once they do, they would then own a portion of the ETF, but not the underlying asset specifically. So in this example right here, the investor is buying a share of this new healthcare ETF. They're not buying specifically a share of Pfizer, Merck, or anything like that. They're buying a share of that ETF, which owns the underlying assets. So in a sense, it seems like they would own the underlying assets, that stock specifically, the Pfizers, the Merck, or whatnot in this instance. But no, they're owning a part of the ETF, which owns the underlying assets. So they own part of the owner of the assets right there in this scenario. That's how it works with exchange traded funds. So if the ETF has underlying assets that pay a dividend, these dividends would be distributed to investors of the ETF based on the number of shares the investor owns of the ETF. So it's like you're owning the individual stocks. Like if you own individual stocks, like me personally specifically, I do own some Pfizer, own CVS. I'm just trying to think of the healthcare names I own in this example right here. What else? There's some other ones as well, but it's not about my specific portfolio. So yeah, so I own those individual stocks. So I get paid a dividend and I just let it drip. So I do dividend reinvestment where it just buys more shares of the actual companies and everything. So, and then, so when the dividend is paid, I get paid right there for the dividend. And so it's going to buy more of the shares and everything. So in this scenario, if you own part of this ETF, this healthcare ETF, that and they pay a dividend, the certain stocks pay a dividend, well, you would receive a dividend as well right there from, like, you own the stock. It's like you're owning the stock because you receive the dividend. But in this scenario, you don't own the stock, you own the ETF. But the ETF is composed of stocks that pay a dividend. So you still would get the dividend amount. So that's why ETFs have dividend yields. And you'll see that. And I'll talk about those later. And so investors can buy more, hold, or sell some of all of their shares in the ETF anytime the market is open. So typically investors buy ETFs as a long-term investment. You buy a certain amount, every month or something like that. You're just building up a nice big portfolio of, ETFs, which own those various stocks and everything like that. So you're building up a nice, well-run portfolio. Long-term, it's been shown in statistics, long-term owning quality ETFs is a great way to go right there. Just doing, dollar cost averaging, putting a certain amount reoccurring every week, every month into different ETFs. That is a great way to invest. I mean, that is low stress, nice risk reward scenario right there to invest right there. You just put a certain amount every month, every week or something into various different great quality ETFs, and you're going to get great growth. I mean, I think the average is around 9% as far as like growth, and like the SPY, one of the main, indexes right there, one of the main ETFs that follows the S&P. The S&P 500 overall, growth is around 9% when you zoom out of it. I mean, yeah, this year is bad, maybe another year is bad, but overall the market is growing. You zoom out, you look at the charts, overall we're on an upward trajectory. So that is a way, dollar cost averaging, maybe you buy some when it's low, maybe you're buying some when it's high, but overall you're getting a nice average. And so that's how a lot of people invest in ETFs. They just a long-term investment. Yeah, you can buy and sell throughout the day, as the market is open. People day trade, hope buying something and selling within a day, or swing trade, buying something for a couple of days or a week or something and then selling it. ETFs, you can do that with ETFs. However, typically I think investors buy ETFs as a long-term investor. So there's that option to buy and sell throughout the day, throughout the week. But also there's the option to hold for a week, for a month, for years, for decades. So that it just depends on what you want to do. It's very flexible with exchange traded funds. A lot of ETFs, of course, are already available. So the creation part is already done. Like Vanguard, they have several different ETFs. So for example, the VOO in the ETF is already created. It's established, it's there. So that first part, designing a fund and all that, investing in securities, that's already been done. Yeah, there's still some buying and selling and everything and owning underlying assets that may get shuffled around, but it's already complete. It's already done in a sense. That major part right there, determining what that ETF is going to be about, is already done. So that part is done. So then it's just available on the exchange. So then it just pretty much comes down to the investors buying shares of the ETFs or fractional amounts of the ETFs to build a position of an already established ETF. And so yeah, new ETFs are still being created by major companies and companies that aren't as big as Vanguards and the iShares and companies like that. So that first part will still be a scenario in this inception to an investment. But there's several already established great ETFs out there. So that first part really isn't a part of the scenario in buying an ETF because it's already established. So it pretty much comes down to the individual investor of how you're going to invest in that ETF, whether platform you use, whether it be SoFi, E-Trade, Fidelity, Robinhood, whatever it is, you're going to be putting that amount in your brokerage to buy shares of the ETF or fractional amounts of that ETF. So it just comes down to that part because already established ETFs, that first part is already done, overall. So it just comes down to the individual investors making investments in the ETFs, and the ETF provider, of course, keeping the ETF, doing well. They want to do well, like I was speaking about before. They want to make sure ETF is doing well. So if it's following a certain index or anything like that, of course, they can't do too much to shuffle things around to, help it do well because they're trying to follow the index. If the NASDAQ is doing well, an ETF that follows the NASDAQ is going to do well. So if the NASDAQ is not doing so well, the ETF following the NASDAQ is not going to do so well. So, but if the ETF is doing, poorly because it's not mimicking the asset, whatever it's following that well. Maybe the NASDAQ is doing really well, but there's been some rebalancing issues of the ETF. It doesn't have as much weighted volume of a certain amount of stocks or something like that. Something's going on right there. Well, then it could be a management issue right there with them making sure they're actually mimicking whatever index or theme they're going after. Maybe they need to shuffle some things around, own more of this company, less of that company to do well. So yeah, there is still work that's done in ETFs behind the scenes through the management style and everything to make sure that ETF is going along with that index or that sector and everything like that. So that can cause, of course, the net asset value. We'll talk about that in the amounts of the securities and holdings in the ETF to change for sure, the weighted amounts and different things like that. But for us, the individual investors, for me and you, our part is basically figuring out which ETFs we want to invest in. So doing the research. I want more of the energy sector. I want more of the technology sector. I want a broad sense. I want more US stocks, more, international stocks or more dividend stocks, but I don't want the individual stocks. And maybe I do want some individual stocks, but I want a broad sense. I want a big basket of them. That's where we come in deciding what ETF we want and going to our brokerage account, whether it be, SoFi or E-Trade or Robinhood or Fidelity, and then buying parts of that ETF, fractional amounts or whole shares of the ETF, and just depending on how often you want to buy them. Me personally, I never go in a lump sum amount of an ETF or individual stock. I don't ever say, okay, I want to own, $2,000 worth of this. I'm going to put it all in at once. That's not the way I would do it right there, because you go in all in at once. Maybe you timed it perfectly. Maybe you timed the bottom of the market for now, and that's wow. Good, awesome, congratulations. However, that typically doesn't happen. So, and then the next day or next week it drops down, drastically. It's like, wow, well, I went in all in at that price, and that's what I'm stuck with until I go more in later on. But if you dollar cost average, going, okay, I'm going to go in $100 today, $100 tomorrow, or $100 today, $100 next week or next month. You're getting an average amount right there. Nice. You're getting the ups and the downs, the lows, maybe some of the highs, some of the trading sideways. So that's the way. The same way I invest in individual stocks is the same way I invest in ETFs. Not all in at once, just certain amounts here and there. And I typically, I keep certain amounts going in, monthly or weekly with certain stocks and ETFs. However, when there are massive drops in price, macroeconomic conditions causing massive drops in price, that's where I go in a little bit more. I'm going to buy more of the individual stocks, maybe more of this ETF, because it's really getting hit. And I don't think it's going to be down here for that long, or I don't think it's going to be down here forever. It's definitely overall, I'm thinking, oh, this is going to be much higher years from now. And I'm a long-term investor, so I'm looking long-term, years, decades from now. So and when things are really getting hit, that's when I want to buy more of them, because my time frame, hopefully, I'm not trying to be in and out of these stocks and ETFs. So I'm trying to hold them for years. So I'm thinking down the line, like if this is a quality ETF, a quality stock composed of, great securities, then I'm looking to stay in it long term. So I'm going to take advantage of these price drops and own more of it than I normally would. So that's how I look at it. But now let's get into some terms that are relevant and related to ETFs that you'll see often when you're researching ETFs on the websites or on, articles and everything. You'll see these terms and these acronyms. And in case you're wondering, what does that mean? Or how does that mean? What's that relation to the ETF? Does that mean it's a good thing? It's a bad thing? So let's get into these definitions here. First off, we have NAV, N-A-V, which is net asset value. This is the market value of an ETF's total assets minus liabilities divided by the number of shares outstanding. So this is kind of like the value of the ETF, what's its worth on a per share basis, similar to book value, because you're just getting the assets minus the liabilities. For example, if the ETF had total assets of 200 million, but the liabilities were 10 million, then that net asset value is going to be 190 million. So this will give you the net asset value of the ETF, which can be different than the market price. And speaking of market price, premium is something you may see in relation to ETFs. Now, the premium is when the market price is higher than the NAV, the net asset value. And then you have a discount. A discount is referring to when the market price is lower than the net asset value. So it's like you're getting a deal, so to speak, when the market price is lower than the net asset value, because you know for sure that the value of it is at this certain amount right here, but the market price of something is below it. That means you're paying less than what the value is calculated, and that net asset value is calculated at the end of the market closing right there. And so, but then you have the premium, and the premium, if it's higher than the net asset value, that means you're paying more for it. But The thing with net asset value is that it doesn't necessarily account for projected growth in a sense. So if you got a lot of high growth assets, securities, and everything in this ETF, well, then the net asset value isn't going to have that priced in, so to speak, because the net asset value is dealing with the hard numbers, assets, liabilities, numbers that are for certain. It's not going to be able to calculate in, oh, well, these securities that this ETF holds are on a high growth trajectory, like in 5 years they may be 500%, or they may 5x, may 10x, may 3x, or something like that. It's not really accounting for all that growth that could possibly be. And then you have AUM, which is assets under management. That's the total market value of assets a fund manages right there. So you can see that is, so to speak, like the market capitalization, so to speak, of these ETFs, the assets under management. That's the total market value of the assets a fund manages. And then you have the market price, which I was speaking about with the premium and the discount. The market price is determined by the midpoint of the bid and ask prices. Now, bid and ask prices, which can be related to the bid-ask spread as well. So we'll speak about both of them right now. The bid is the price at which investors are willing to buy an ETF on an exchange. And the ask is the price investors are willing to sell an ETF on an exchange. And the difference is the bid-ask spread. So this is the same when it comes to stocks. You have bid prices and ask prices. So you'll see that kind of if you look in more detail of a market price of a stock, just like an ETF. So like the bid is what investors are willing to buy it at. That's what you're bidding on, kind of related to that and speak. And then you have the ask, which is what people that own it, that security, are asking to sell it for. That's what they're going to ask you to sell it for. And those have to pretty much meet up to get that price point right there, that midpoint right there. So the difference between those two, and that's the bid ask spread. Now, next up, we have the total return. This represents the changes to the net asset value and accounts for distributions from the fund. So when an ETF is composed of great, securities, great stocks and everything, that net asset value, well, that should be going up because the companies, that it owns, the ETF owns, have more assets, and then hopefully less liabilities, or maybe the liabilities may grow as well. But if the assets grow more than the liabilities, that's what you want. Of course, you want to be positive in that spend. You want to have more assets than liabilities. If you have that cash flow coming in nicely every year, every quarter, and everything just growing, well, your assets going to be better than liabilities if you're not taking on a lot of debt and everything. So that total return, you want to see that go up over time. Next up here, we have the expense ratio. The expense ratio is the total annual expense of an ETF that covers their cost expressed as a percent. This fee is deducted from an investor's dividend and the capital gains distributions from the ETF. It's not deducted from the invested principal amounts. Let me give you an example of an expense ratio. Let's say you're investing in an ETF that has an expense ratio of 0.2%. That means that for every $1,000 you invest in that ETF, you'll be paying $2 annually in expenses. So, and now it's operating expenses right there. And that right there will not be taken out of your principal amount. So not out of that $1,000, let's say, if you were investing just $1,000 in an ETF, that $2 annual fee will not be taken out of that $1,000. Instead, it will be taken from the actual dividends and capital gains that will be distributed from that ETF to you, the investor of the ETF. So when you're picking ETFs, it's definitely important to look at those expense ratios. I mean, those amounts can be small amounts for sure, but they can make a big difference right there depending on how much you're investing in an ETF and how it's growing and everything. Those percentages right there with the expense ratio, because you want to be investing in high quality, great ETFs, but you don't want to be paying a ton in fees just for holding and investing in that ETF. So definitely important to look at those expense ratios. The next term we have is benchmark. This is the index, sector, or reference point an ETF is meant to track, and it can be used to measure or evaluate the performance of investments. So for example, like an ETF that follows the S&P index, that's going to be their benchmark. They want their fund right there to mimic what is going to be the return from the S&P. So all the companies there, same if it was an ETF that tracks the Dow, it's going to want its return from the ETF right there for investors to match what the return from the Dow would be if you held all those companies right there. So that is the benchmark. It's used as a reference point and also to evaluate and measure the performance of an ETF. Now the next term, holdings. The holdings is the number of securities, stocks, bonds, etc. the ETF holds, excluding cash positions and derivatives such as futures contracts. So if you have an ETF that has 100 stocks in it, that means it has 100 holdings. When you look at the holdings section of the ETF, you'll see a long list of all those stocks right there, depending on how many it holds, stocks, bonds, and etc. That's going to be the holdings. So when you look at number of holdings of an ETF, that's the underlying assets, how many of those that the ETF holds, excluding cash and derivatives like futures and contracts, things like that. Now, next we have 30-day SEC yield. So yeah, that's SEC, Securities and Exchange Commission. This yield reflects the interest earned after deducting the ETF's expenses during the most recent 30-day period by the average investor in the fund right there. So this yield is definitely important. You want to look at these yields and compare and contrast when you're comparing ETFs to see, what has the better yield, because this is the interest that's earned after you deduct those expenses, like that expense ratio and everything, for the most recent 30-day period. So you'll see the SEC yield usually on, information when you're researching ETFs and everything. And then you'll also see sometimes the distribution yield right there, right next to it, underneath it, on top of it, right around that area. And the distribution yield is also known as the 12-month trailing yield, the TTM. That's 12 months trailing yield. It's a measurement of cash flow. Now, it's calculated with all distributions, dividends, and capital gains in the trailing 12 months and then divided by price. So that's the calculation for it. All distributions, dividends, and capital gains in the last 12 months divided by price. So the distribution yield is something you definitely want to pay attention as well to get a sense of what's going to be kind of your return when you're holding this ETF. And around that distribution yield and the SEC yield, you'll also typically see the dividend yield. And the dividend yield, and then this is how much the ETF pays out in dividends each year relative to its share price. So if the ETF holds a lot of companies that pay dividends, have high yields themselves, well, then this dividend yield will be higher than other ETFs that maybe don't have as many companies that pay a lot of dividends or don't pay any dividends at all. So just depending on how many companies the ETF holds that pays dividends and what their dividend yield is, now that's going to be reflected in the dividend yield for the actual ETF as well. If it has a lot of high yield dividend companies, well, the ETF dividend yield is going to be high as well. And it could be lower. Just depends on what is that focus of the ETF, because some ETFs, they focus on that dividend focus. Some aren't necessarily focused on that. They're focused on sector or, index or different things like that. And some, it depends on what companies are a part of that sector or part of that theme or part of that index that will reflect in the dividend yield. Not all companies pay dividends, and some companies that pay dividends only pay, maybe 1% or 2%. Then you have some that pay 4% or 5%. And then you have some that pay 7, 9%. Sometimes that gets into a risky territory, because a dividend yield that's high isn't always a great thing. Typically, a dividend around 3, 4, 5 is usually kind of solid, depending on other, of course, factors in the company and everything, and other financials and everything. You definitely gotta look at that. But a high dividend yield is what I'm trying to say is not necessarily a great thing always. 7, 8, 9, 10 double-digit percentage. It doesn't mean that it's great. If you just see a high dividend yield isn't always a great thing. You definitely have to look at the underlying factors, the payout ratio and different things like that to determine if that dividend is safe. Sometimes a high dividend is just won't be safe. It could get cut, could get taken away, because if the company cannot afford to pay that dividend out each year, each quarter, and everything, well, that dividend is going to get cut. That cash flow has to come in to pay for that dividend. So dividend yield is definitely something important to look at, but you got to kind of watch out and not just be attracted just to dividend yield, because you have to see if that dividend yield can be covered. And that's mainly for, individual stocks and everything like that. Of course, the dividend yield is reflected in the ETF as well. Dividend yield is important, but it's not everything. So let's get to the next term here. Beta. Now, beta is a measure of how a security tends to move in relation to the market or index as a whole. A 1 indicates it will move in line as the market moves. More than a 1 would mean that it's more volatile than the market, and less than 1 would mean it's less volatile than the market. So let's say, for example, if a stock or an ETF has a beta of 1.8, that would mean that the movement of the price for that stock or ETF is going to be 80% more volatile than the movement of the market as a whole overall. So, if the market goes up, then that stock price or that ETF price is going to go up 80% more than what the market moved as a whole. And that works in the other direction as well. If the market is going down, then the price of that stock or ETF will be going down as well, but 80% more down. So it's going to be the lows are going to be lower and the highs are going to be higher. So if you have a beta more than 1, that means it's going to be more volatile than the market on its way up and on its way down. And a beta less than 1 would mean it would be less volatile than the market on its way up and on its way down. Now, a negative beta would mean that it's going to move in an opposite effect of the market as a whole. So that is the beta. It's a risk measurement right there. So next up, we have the PE ratio. And the PE ratio is the price to earnings ratio, and it is the price per share of a stock divided by its earning per share. For an ETF, the ratio is a weighted average of the stocks it holds. So it's not just based off one stock or two stocks, different PE ratio. It's based off all the stocks it holds for an ETF. So you can get a roundabout way of seeing if how that ETF is valued relative to its underlying assets and everything, looking at that PE ratio and comparing it to other ETFs. So if the price is really high but the earnings are low, then you're going to have that high PE ratio. But if the earnings are really high and then the stock price is in line or it's low or something, you're going to have a lower PE ratio. And next up, we have the PB ratio, which is the price to book ratio, and it measures the market value of a stock share price relative to its book value. In general, the book value of a company is equal to total assets minus liabilities. So for an ETF, this ratio is a weighted average of the stocks it holds. Now, with the book value and the price to book ratio, sometimes this is best to be used for certain companies and everything, depending on what sector it is. Like, for instance, financials and banks. Investors will typically use the PB ratio instead of the PE ratio when determining if a bank stock is undervalued or overvalued, because this is the assets on the book, on the balance sheet and everything, minus the liabilities. And like, for example, with the book value of a company, let's say if the company was completely liquidated, everything taken away right there, this is what the company would be worth right here, because this is what the assets are on the balance sheet minus liabilities. You have to pay off all the liabilities with all your assets getting liquidated. This is what's left. This is what the company's worth. So this is sometimes used to compare and contrast different stocks in the same sector to see, what's more overvalued, what's undervalued, what's overvalued, and different things like that. And also how the PE ratio is used, the PV ratio is used as well, but more on that concise numbers, how is what's going on that balance sheet. And that weighs more importance with the PV ratio than the price to earnings ratio, because it's kind of hard to price in growth in a company sometimes with the PE ratio. Some companies, they warrant that high PE ratio. Not every time you see a high PE ratio is it like hands off, oh, I shouldn't touch that, the PE ratio is high. It may that those companies or that company, if it's one stock, or that those companies, if it's an ETF, may be having a lot of growth, just every year, just growing like crazy. Well, that PE ratio might be a little high, but that PE ratio is going to be eventually they'll grow into that PE ratio. You'll hear that sometimes, where you're going to grow into that PE ratio because those earnings are going to be going up so much. So you're going to grow into that high price you have. Sometimes it's the other way around. You can find a deal, find something undervalued. The PE ratio is low, but the earnings are there, and it's just not catching up with the stock price. So it's great to compare and contrast different PE ratios or PB ratios from different stocks and ETFs in this case, just to kind of get a sense of where it may be heading, or where it's been heading in the past, and what what's been going on in the past can be determining what's going to happen in the future sometimes. All right, now let's look at an overview of the first ETF that was available in the United States, the SPY, created in 1993 by State Street Global Advisors. When this ETF was created, it had around $6.5 million in assets. Now in October 2022, it has around $340.8 billion of assets under management. So yes, a major jump. This is one of the most popular ETFs. So I just kind of want to show you an overview of it on their website, and you can see some of those terms I was telling you about earlier and everything. So yeah, this is the SPDR is referred to as well, the SPDR ETF. It tracks the S&P 500 as its core benchmark. So that's what it's trying to mimic right there, that return. And this is the SPY right here, the SPY, some people say, or the SPDR, some people call it. So right now you'll see the net asset value is $373.28. Then the gross expense ratio of 0.0945%. The three main indexes in the United States, you have the S&P 500, the Dow Jones, and the NASDAQ. So yeah, this one right here follows the S&P 500, like you see right there, launched in 1993 January, the very first exchange traded fund listed in the United States, and it's still going, and definitely one of the most popular ones, one of the most traded ones. The volume is very high on this ETF right here. And yeah, you got the benchmark, like I was saying, the S&P 500, inception date when it was first started, expense ratio, and administrators, sponsors. Got the ticker symbol SPY, and you got the number of holdings, 503 holdings right there. You got the price to book ratio, 3.55%. The price to earnings ratio, 16.76%. And you got that 3 to 5 year EPS growth, the earnings per share growth right there, 12.41%. And right here, the yields, as I was telling you about earlier, 30-day SEC yield. And then you have the fund distribution yield and the index dividend yield right there. So you see how the SEC yield is slightly different than the distribution yield right there. 1.65%, and then 1.62% for the SEC yield, and 1.65% for the distribution yield, and at 1.76 for the dividend yield. So right now you see like the fund distribution yield, the sum of the most recent 12 distributions within the past 365 days divided by net asset value per share expressed as a percentage. The index dividend yield, the weighted average of the underlying indicated annual dividend divided by price expressed as a percentage. 30-day SEC yield, also known as the standardized yield, an annualized yield that is calculated by dividing the net invested income earned by the fund over the most recent 30-day period by the current maximum offering price. You hit the fund market price, or that bid and ask I was talking about earlier, closing price, and the day high and the day low, because like stocks traded on at brokerage and exchange and everything, ETFs have their highs and lows right there. So that's what it was trading as of October 6th on the last trading day. Right now I'm recording this on the weekend, so the market is closed, but that was the high and low on that day. And there's that premium discount. Days traded at the premium, days traded at the discount. So the days it was trading above that net asset value, days it was trading below that net asset value. And there's the fund net asset value. You got fund performance, so you can see how it's been performing. You can see this for all of the spider ETFs right here. So the other ones that aren't, of course, the SPY, they have several other ETFs as well. And you'll see this on Vanguard's website, the iShares. You can look at all this information. It's definitely interesting and definitely important to look at when choosing an ETF. And of course, you can look at Yahoo Finance or Google Finance and different websites like that to get a general idea of how the ETF is and their core holdings and stuff. On their brokerage, like for instance on SoFi, where I used to do a lot of my investing for my individual account, not my like retirement or Roth accounts or anything, but I use SoFi for my individual investment accounts. And you can see on the ETFs, the top 10 holdings and everything right there. And you can see some of the data and statistics. So it kind of gives you a general concept. If I want more information, then I'll go to somewhere like Yahoo Finance or, Market Beat is that one I use, and, other websites and everything to kind of get a general idea of what a Bloomberg, CNBC, to get a general idea of more information about the ETF. And that's when I would go to the website for the ETF and get really into it right here, as you see on this website, because you got the performance and you got the holdings we can go over to right here. And then you go the fund's top holdings, where there's going to be these major companies right here. Apple, Microsoft, Amazon, Tesla, Alphabet, that's Google right there, Alphabet Class A, Class C, Berkshire Hathaway, major corporations right here. And you have a breakdown of sector allocation. So the percentage in information technology, percentage in industrials, percentage in financials, energy, utilities, consumer staples, consumer discretionary, healthcare. Nice breakdown here. You can see what this sector and what the fund, the allocations are there and everything. So with this sector tracking the S&P index, it's going to want to pretty much have the exact same. So as you see right here, they are on track, just looking at the sector allocation of what the S&P is. And the major corporate top holdings right here on track, looks like they got the weight of them, 6.98% Apple, and so that's what they want to do with this ETF. They want to mimic the S&P 500 right here. So you got the sector breakdown, and yeah, got all the reports or prospectus. So like I say, if you want the most information on an ETF, check out the website for the company that provides, creates the ETF. So that's where you're going to get that. Just great transparency. You can look at what's involved in ETFs, because when you're buying these, this is something you might not be looking at that often. When you first buy it, you want to see what it holds, how it's been performing, and then you're like, okay, I'm going to invest in it. I'm going to invest a certain amount every month, every week or whatnot. You may not look at this again. Maybe you'll check on it in a year. How's it doing? In a few months, how's it doing? If you're not really into checking on it, every week, and that's fine, because that's part of the reason why you invest in ETFs, is to get all this exposure to these different sectors and different great companies, but to be more hands off, have more time to do other things you want to do. You don't want to be looking to see how these companies are doing every, quarter or every week or every, financial statements coming out and everything. You don't want to be on an earnings call listening to that and everything. That's not interesting to you, and that's totally fine, but you want to grow your wealth, right? You want to make more money, right? Well, yeah, you definitely want to be invested. And this is a great way to get invested in major corporations in America and around the world. ETFs right here, definitely. So this is a definitely less stress, less time way to grow your investments, is investing in a great ETF and just dollar cost averaging, just putting money into it however is great for you as far as the frequency, whatever works for you. So yeah, you see this performance right here. So you see like, yeah, it's down over the month, quarter, year. You know how the market's been going this year in 2022. So yeah, but okay, a year. But then you look at, okay, like I say, zoom out some, 3 years. Oh, we're up. Oh yeah, this year's been bad, down. Let's see, negative 11.3% in net asset value. The S&P is negative 11.23%. Yeah, look at 3 years though. We're up 12.24%, and that's right here. And 5-year, 11.67%, 10-year, 12.93%. Since inception, and January 22, 1993, all those ups and downs, the dot-com bubble, the financial crisis, pandemic, for all that right there, since inception, this fund, for example, still up 9.73%. So that's what I mean by zooming out. So if you put your money into this, let it go through the ups and downs. And I'm not saying this ETF is specifically, but this is a great ETF. So, but something like this, or this ETF or something related to it, I'm just going to show this one because it's the first one. So I want to show you how far it's came and how it's doing, currently and since inception and everything. So this is definitely very neat to look at how the returns are and everything in this spectrum of time. So you could just see, even if the market's bad, you don't take these years off, because the thing is, like, if you don't invest when the market is down and you just invest when it's up, well, then you're not going to get these great prices when it's down. Let's say we'll go to a different ETF. We'll go to VOO, Vanguard. This is their S&P 500 index right here that mimics, that follows it as their benchmark. So let's zoom out 5 years roughly. Okay, so let's say, you just invested in this when it was in, peaking in 2021. They were just taking off from that March 2020 low. And this is a great time to invest, of course. I was definitely investing in a lot of stocks during this time right here, because I know things were just getting hit too hard. So anyways, let's just see. If this is when you was riding up, you're like, oh yeah, I'm buying this at 393 and 403 and 415. I'm throwing money at it like crazy. Okay, I'm throwing money at it. Oh, it's going down. I better stop. Well, your average price is around $400. Okay, maybe you're putting $20 in every month, or $100 in every month or something, and you stop right here because it's down. Well, you're not getting those deals when it was 236 and 276. And look, we're down right here for this year, but we're not down as much as it was right there. So I mean, if you really bought right here, you could still be up and things like this. That's how it is for a lot of stocks. I mean, like, even if with these big decline this year, if you bought dollar cost average or bought more during these downtimes and everything, there's definitely a possibility you're still up. I'm still up in several stocks because I've been dollar cost averaging through this up part right here and through these down parts, but I was buying more during these parts. And I'm getting to that area right now where I've been trying to buy more of certain stocks and ETFs and everything. And I'll do videos on that, my top, stocks I bought in September and October. This is not financial advice. I'm just trying to let you know, like, dollar cost averaging, putting money in great quality stocks and ETFs, very important. So yeah, you want to get the high, you're going to get some of the highs, yeah, you're going to get the timing off, but you're going to get the lows. You want those lows as well. You don't want to not invest during these lows. And I'm just looking at this little chart. I know I can maximize this to get full screen, but I just want to give you an overall general, amounts and everything, how things dip right here. And this is the Vanguard 500, the VOO, which is kind of pretty much like counterpart, or I don't want to say a competitor, but this is equivalent to the SPY we were just looking at on the spider right there. So yeah, and and like I said, another place to look at information for an ETF is something like Yahoo Finance, where you can get an overview. You can get the expense ratio of 0.03% for this one. You get the PE ratio 12.6%, the yield, so the net asset value. So you can get a general overview of information, and you can get a little bit deeper in this one as well. I do like Yahoo Finance a lot. They got a great app, so you get a lot of information on this as well about the funds and ETFs. So the information is out there. Like I was saying earlier, the transparency and accessibility. This is part of it right here. And accessibility, you got an internet connection. You can find out more information about these ETFs and their holdings and their performance and everything like that. And then for the accessibility, you can check out more information on these ETFs for free. You got an internet connection on your phone, website, and computer, through websites like Yahoo Finance or Seeking Alpha or Bloomberg or Google Finance, different, whatever you use, whatever you like to use. You like that chart, you like how this is presented. However, you get information on these ETFs, and the transparency, you can see what their holdings are, how their performance is, So it's definitely interesting, and the information is there for you. And hopefully this video helped you learn more about what an ETF is, how to invest in them, how they work, and just some of these, definitions and terms, and where to find out more information on them and everything. And now, next up for this last part of the video, I'm going to wrap it up. I'm going to show you how easy it is to invest in an ETF. All right, now just for the last part of this video, I just want to show you how easy it is to invest in ETFs. So I'm on the SoFi platform right here, which is one of the brokerages I use to invest in stocks and ETFs. And I've been wanting to add more emerging market exposure to my portfolio in this account right here. So I've been looking at the VWO ETF provided by Vanguard. Look at the expense ratio. I'm seeing the yields and everything. And for me, the research I've done, everything, this is what I want to add. I looked at the top holdings. I do hold Taiwan Semiconductor already. weekly, but all those other holdings, I want to get exposure to them right there, Alibaba and Tencent. So what I'm going to do, I'm going to set up a weekly purchase investment of this ETF, and I'm just show you how easy it is right here. Of course, this is the top holdings. So right now I'm going to go ahead and buy it. I'm going to set it up, and I'm going to set the date on Wednesday. I just want to do, VWO. How about that? VWO Wednesday, So I'm going to set it up for Wednesday every week right there, and then I'm going to put in my amount that I want to invest in. I could do, $5, $10, $100, any amount like that. I'm going to do $5 weekly, and then I select my bank account, and then boom, that's it. I'm investing weekly into this ETF. And now I just want to show you how easy it is to invest in an ETF just outright without doing it weekly, just a one-time purchase right here. And so now I can set up how much I want to buy the ETF. I can do a market order, I could do a limit order and select a certain price that I want to, buy the ETF at, or I could just put in a certain dollar amount. I don't have to do per shares like I was telling you earlier in the video. I could do a fractional amount. So I'm going to put in just, a $5 order right here to start investing in VWO, and let this go through right here, and a market order. So it's going to go in between while the market is open right now, anytime right now. And this one, sometimes for ETFs, it takes a little bit longer than stocks when you're buying them. This one I had to wait a few minutes, but my connection was a little slow right now, as you'll see the loading and loading. After a minute or so later, I'm owning VWO already. And this is before Wednesday, my weekly buying, frequency and everything. So I just wanted to show you how easy and accessible it is to invest in an ETF. And that is it with the video. I hope you all enjoyed it. Have an awesome day.